All right. What is up, tycoons? What's up, traders? Super excited for today's video. We're actually going to give a natural gas news update. We're going to cover some of the recent news around natural gas, and then we'll also go into a nice technical analysis, give you guys an update on the charts in the second half of the video. So if you just want technical analysis, you can just fast forward to the second half. With that being said, make sure to smash the like button, subscribe to the channel if you guys are new. I'm doing natural gas videos every single week, keeping you guys up to date. So if you're looking for somewhere to get some constant updates on natural gas, on UNG, oil, this is definitely going to be a good channel for you guys. So our first headline here, U.S. natural gas dropped 7% to 3-week low on milder weather forecasts. The U.S. natural gas futures dropped 7% to their lowest level in 3 weeks on forecasts for milder weather and lower heating demand than previously expected. Front month natural gas futures for April delivery fell 17.6 cents, or about 7%. The weather outlook for later in March has shifted from colder than normal along the eastern seaboard to slightly warmer than normal, reducing the expectation of late season heating demand, said Gary Cunningham, director of market research at Tradition Energy. We are expecting gas demand for power generation this summer to set new records as switch over from dirtier fuels like coal to natural gas continues to be the trend here in the U.S. Meanwhile, gas flows to LNG export plants have been on track to hit record highs since Freeport LNG's export plant in Texas exited an 8-month outage in February. The plant was shut down due to a fire in June of 2022. And here we can take a look at the nat gas futures. No changes to the consolidative theme. Over here, we have a chart showing the volume, open interest, as well as the price of natural gas. All right, considering advanced prints from CME Group for natural gas futures markets, open interest rose by around 6.2K contracts on Thursday after 2 consecutive daily pullbacks. On the opposite direction, volume kept the choppiness well in place and went down by around 54.8 thousand contracts. Natural gas, the upside is capped by $3 so far. Thursday's small uptick in the prices of natural gas was amidst rising open interest and a moderate retracement in volume. Against that, the continuation of the consolidative phase is expected to remain unchanged for the time being, with occasional bullish attempts still limited by the $3 mark on natural gas. All right, we take a look here, and it talks about how the U.S. natural gas futures rise as utilities draw less gas from storage. Some of the key takeaways were that the U.S. natural gas futures increase, but lower demand resulting from less cold weather forecasts limits the game. The U.S. EIA, the Energy Information Administration, reports utilities drew less gas from storage compared to the same period last year and 5-year average. Refinitiv predicts a decrease in U.S. gas demand, including exports, and federal regulators approve restart of Freeport's LNG 3 liquefaction trains, increasing U.S. LNG export capacity. Now, the U.S. gas stockpiles dropped to 36% above average. And Refinitiv predicts a decrease in U.S. demand next week. They're a data provider, and they basically predicted that the U.S. Gas demand, including exports, would decrease from about 120.5 down to about 117.8. Freeport's LNG trains have been approved for restart after the fire outage. Okay, so federal regulators approved the restart of 2 of Freeport LNG's 3 liquefaction trains in February and the 3rd on March 8th. Liquefaction trains are used to accomplish the process of turning gas into LNG. Since the Freeport LNG export plant in Texas resumed operations after an 8-month outage caused by a fire last year, gas flows to LNG export plants have been on track to reach record highs. When working at full capacity, Freeport LNG can produce about 2.1 billion cubic feet of gas for export. Together, the 7 largest LNG exports plants in the U.S., including Freeport LNG, can produce about 13.8 billion cubic feet of gas for export. Now, in international news, Russia expects its oil and natural gas production to drop in 2023. They expect it to fall this year compared to 2022, partly due to the production cuts announced for March, Russian energy minister told lawmakers on Wednesday. For 2023, we expect oil production levels to be slightly lower, also because of the voluntary reduction in output. Gas production volumes will continue to decline, both due to the abandonment of the European market and the timing of the rerouting of energy flows to the east. Now, Russia's decision to reduce its oil production this month will help balance the global oil market, which is in a surplus now. And the Russian production could be a sign that Moscow may be struggling to place all of its barrels, or maybe an attempt to shore up oil prices, the International Energy Agency said in its oil market report for February. Now, that's going to be it for some of the news. All right, we're actually going to head on over to TradingView now. And we're going to start off here taking a look at the natural gas futures. We're looking at the monthly chart right here. All right, so this is going to be a monthly time frame. And the main thing I want to highlight here is we have our demand zone down below right here. This is an area where there's an imbalance of buy orders. That's what creates a demand zone. And that imbalance of buy orders, AKA demand, pushes the price higher. And we can see that previously in the past, 2016, when we came down to this level, we ended up pushing back up higher. Here in 2018, we touched the level, we kissed it a few times, and we push up higher. We established 2 supply zones overhead in that time period, right through these regions. And those supply zones are currently the ones that we're battling right now. And today, here in 2020, we also dipped back down into this demand zone and we pushed up higher. We come back down, we kissed the demand zone, push up higher. And we recently came back down and kissed this demand zone with this candle right here. Now, this candle in particular, let me zoom in a little bit for you guys so you can see it even clearer. This is known as a hammer reversal candlestick. Okay, and so the month of March needed to be going green here. All right, we needed to see this candle close above this candle, and in the beginning of March it was right. We wicked all the way up here and things were looking good really for March. Now that we're about halfway through March, we can see that it's gone down, okay? And we actually have a pretty bearish candle right here. You see, because we opened here, right? And buyers pushed up, pushed price higher, but rather sellers came in and took the control and they actually pushed it below the closing or below the opening price. And so this right here is a pretty bearish candlestick. Now, remember, the month of March is not over, okay? So really, this is our closing candle for February. And so there's still time for natural gas to possibly reverse back up higher and ultimately get the confirmation we need for this to be a hammer reversal candlestick. Otherwise, if this candle ends up closing around this type of structure right here, this is going to be pretty bearish. Okay, now we could end up getting another doji, and that would be where essentially the body of this candle closes somewhere up in this region and we have a candlestick that looks something like this, right? So we can look out for a doji. That wouldn't be the best sign ever, but it really wouldn't be a worse sign either, right? It's just a lot of indecision when it comes to the candlesticks. Now, the main natural gas futures, supply and demand zones, okay, the demand zone is going to be right here. This is roughly about 110 all the way up to about 160. Okay, and then we have for our supply zones overhead, we have 220 all the way up to about, I'd say about 265 right here. Now, a supply zone is just like a demand zone. It's an area where there's an imbalance of sell orders, right? So there's an imbalance of sell orders, meaning that there's way more sell orders here than there is buy orders, and it pushes the price down lower, right? Same thing happens over here, pushes the price down lower. All right. And so those are really some of the key areas that I'm watching when it comes to the monthly chart and the overall big scheme of things when it comes to natural gas. If we zoom down to our 4-hour chart, we can take a look here. All right, and take a look at our rising wedge that we had. Now, if you see here, this is that demand zone, and you can see as soon as we came in there, we got a nice doji candlestick and then a very big green dildo right here, big green candlestick. Okay. And we actually put in this rising wedge pattern. All right. So I mentioned this a few times. We were looking to see what was going to happen here. We actually got a very clean break retest of the trend line, and we've continued to push lower. And I mentioned this gap right here, right? So if we stretch this gap out now, we can see that we're actually starting to fill the gap. All right. So, the gap is between this candlestick and this candlestick, and these gaps, they tend to fill about 90% of the time. Historically, the big question is when they're going to fill, not so much if they're going to fill. And so we were looking to see if we were going to be able to hold above our line in the sand, which was about 209.3 right here. And you can see we dipped down below, but these gaps, they also can work as areas of support and resistance. Okay. Because, the candlesticks just, there's no trading volume in these areas essentially, right? So we went from here all the way up to here. So this is a big level for us right here where buyers are stepping in. And you can see buyers stepped in at the gap multiple times, but the more times you test an area, the weaker that it's going to get, right? So the buyer stepped in here, right? The buyer stepped in here again, the buyer stepped in here again, and ultimately those buy orders were diminished, all right? And sellers were able to push us back down. Now, one thing that I do want to mention is that if we only get a half gap fill, that's actually a bullish structure, right? So if you take a look here, this is about roughly half of the gap right here. And if we're able to actually push up higher, a half gap fill is a bullish, a little bit of a bullish structure. So that's something to watch out for, definitely to pay attention to. You could say we have a little bit of a falling wedge here. All right, here's a trend line here. And then we have another trend line here. And you could say that this is a little bit of a falling wedge. You definitely could say that. Now, I wouldn't say it's the strongest one, but we could look for some type of a breakout to take us back to that overhead supply zone. 209.3 is now going to be a very big resistance level when it comes to the natural gas futures, as it was support here, here, right? And even over here, and now we've flipped it from support to resistance, rejecting it. So that's definitely going to be a big area to pay attention to. All right. But most likely, if we continue to fill the rest of this gap down, we could even see natural gas futures come back down and try to test this demand zone down below, because the rising wedge should, in a perfect world scenario, after the break and retest, take you back down to where the pattern started. Okay. Now, here's a really good example of these gaps filling, right? So we have a gap here, and then we have a gap here on these in between these two candles, and you can see that that gap ends up filling very shortly. Okay. Now, let's actually head on over to the spot price for natural gas now that we've taken a look at the futures. And we'll go over that chart because it's really important if you want to be trading oil or you want to be trading UNG or cold or anything like that. You need to be looking at the futures and the spot prices for natural gas. Okay, so we're going to head on over to the Henry Hub and take a look. All right, and we're now on our daily time frame. And I want to go over some of the potential strategies that you guys can use when it comes to trading natural gas. Now, remember, the natural gas futures chart and the natural gas spot price, they're not always going to trade the same and look identical. That's definitely something you want to keep in mind. Now, what I want to highlight here is going to be the MACD as well as the RSI, right? So if you take a look at both of these, you can spot divergences along them, and you can also spot potential entry and exit signals. So let me adjust this just a little bit for you guys so it's a little bit clearer. And what we're going to do is we're going to go over some very simple concepts. So look at the price, the spot price of natural gas. Right here, it's making higher highs, right? We have a high, and then we have a higher high. So the relative strength index should be reflecting that, right? It should be kind of moving with the price of the natural gas spot price. But that's not always the case. Oftentimes you find divergences. So right here where we have a high, we actually have a high as well. And then here where we make a higher high, we actually make a lower high. So we're doing this thing where the price is going up, but the relative strength index is going down, making lower highs, decreasing in relative strength as the price is going higher. That's a bearish divergence on the RSI. And you can see ultimately we have a nice move downwards. Now, once you combine that with the MACD, it gets pretty useful and pretty helpful for spotting potential entries and exits. So here's a potential exit signal. And then if you pay attention to the red line on your MACD, it crosses down below the blue line right here. And that would be an exit signal. So now we have bearish divergence and we have an exit signal on the MACD, giving us a little bit of confirmation that we could see some bearish activity. Now, the same thing happens over here, but in the opposite way, where we have a low and then a lower low. Okay, so now we're going lower in price, but on our RSI, we have a low and then a higher low. So we're increasing in relative strength as the price is going lower. This is a bullish divergence. Then we get a crossover here as well, and you see we get a nice push up. So it's very useful. The MACD is most efficient on the daily time frame. You can use it on larger and smaller time frames, but it typically tends to be most efficient on the daily time frame. All right, now I don't want to repeat myself too much, but here we are. We're making higher highs. We're making lower highs. We get a MACD crossover to the downside, big move to the downside, making lower lows here, making higher lows here, crossover to the upside, and we get an upside move. All right, and so this has continued to basically play out over the past couple of years when it comes to the natural gas spot price. Now, the most important and relevant parts right now is this initial bearish divergence that caused the drop, right? And it's not the only thing that caused the drop, but from a technical analysis standpoint, this is one of the things that caused the drop. So, we got the MACD crossover here. We actually just retested. We broke out, retested, and we're pushing up. Guys, this is what we were looking for and what I was saying you want to be looking for when it comes to the natural gas spot price, okay? Because this initial bearish divergence where we created a high and then a lower high after creating a high and higher highs right here, we haven't retested that level until here recently. And so we came up, we broke out, we came back down, retested it, and now we're pushing back up higher. So that's a very, very good sign. All right. And that's what we wanted to see, honestly. Now, we also have our bullish divergence trend line here. So what I'm going to do is I'm going to extend this out just a little bit more now. Okay. So we can see and understand. All right. And what we want to see is we want to see this thing act now as support rather than resistance. So if we come back down, we do want to be testing these lines and ultimately trying to push back up higher. Now, initially, we have the bullish divergence that we were bouncing off of as well, right? So we have a low here, then we have a lower low and a lower low. But on our RSI, we have a low, we have a higher low here where we got a bounce. Then we continue to head lower, but we bounced even higher and made another higher low on the relative strength index. So if for some reason we do break through this initial bearish divergence trend line, we could come back down and retest our bullish divergence trend line right here. So that's something that I'm going to be watching and paying close attention to, is really those trend lines on the RSI right now. Now, if we zoom in on our MACD a little bit, just so it's a little bit clearer, we can see that the MACD is curling up and heading in the right direction, really trying to get back towards that zero range. And ultimately, we want to see if it can get back above zero. Now, something you need to be cautious of is that exit signal. If this thing curls down and crosses below the blue line here, that could be a potential exit signal. Now, I've mentioned a inverse head and shoulders on a few of these charts. But I never really went over it on the, spot price, but it's been there as well, right? So here we have a left shoulder, okay? And then we got a head, and we just put in a right shoulder right here. And there is a chance that natural gas, when it comes to the spot price, if we break through this 279, 280 region, right? $3, of course, is going to be a big resistance area just mentally, right? $3, these whole numbers are big levels. But if we break through there, this inverse head and shoulders could play out and take us back up to the 3.32 region. I really wouldn't be surprised if that happens. But a lot of things have to happen accordingly, right? And so essentially, we're going to have to break this neckline here. So if you look, we have a little bit of a neckline right here in this area, all right, from these highs right here. And so if we can break this area above that 279, 280, and then break through this trend line here, then we could see that move up to 332 on the natural gas future spot price chart. Now, remember, guys, none of this video is financial advice. I'm not telling you guys to go out here and buy Boyle, buy UNG, buy natural gas futures. Really just trying to give you guys some really good updates, all right, and not be too biased either to the bullish or to the bearish side, right? I'm going to show you guys the bearish chart patterns like the rising wedge. I'm going to show you guys some bullish chart patterns and things like that as well. Now, let's hop into Boyle, okay? And so Boyle, we're seeing a lot going on. Okay, Boyle's has a whole lot going on. We're gonna zoom in a little bit more so we can understand some of the structure and some of the movements here. We'll zoom in on our MACD a little bit. We had some question marks here, and things aren't looking too good at the moment when it comes to Boyle. Our RSI, we still do have this bullish divergence. We're getting close to retesting the trend line. We need to stretch this out a little bit more. But let's take a look here. All right, and so what we have is we have a low here, right? And then we're making these lower lows here, right? So you take a look, you have a low, we have higher lows at these points, even though we're creating these lower lows on the chart, on the time frame. All right, now our MACD right here, look at how tight this is, right? If I zoom in even more so you guys can see, this thing is super, super tight. And when the MACD is really tight like this, usually it signifies a big move is coming. So this could potentially be a big move to the downside if we cross down and cross below the blue line here with this red line. That could provide us an exit signal, and natural gas, Boyle, could see a substantial drop to the downside. So you do need to be cautious of that, right? You do need to be prepared, especially mentally, if that happens, right? Have some type of a hedge or have some type of a stop loss So that way you're not ruined, because Boyle's leveraged and, you know, things can go against you really quick. You can lose 20, 30, 40, 50% of your investment in a very short period of time. And unless you have, you know, really good patience, or unless you have, you know, a really good positive mentality to, you know, be able to look at your portfolio being so down, you know, a lot of times that can cause people to panic sell. Now, if we zoom in a little bit more, we are breaking our inverse head and shoulder structure here a little bit on the, you know, daily time frame. Right here we had the left shoulder, we had the right shoulder, and we're heading back down to this 435 region, right? So what I'm going to do is I'm actually going to get this off. Now, we did have that inverse head and shoulders on the spot price of natural gas, but for now, we're heading back down lower. And if you take a look, we're very close to potentially putting in a double bottom right here at that 435 level. So 435 is going to be a big level for me personally to see what happens if we do get any type of a double bottom there. There is the chance for that. But if we break below 435, 320 is my next major support level for Boyle. Okay. So that's going to be the next big key area of support that I'm looking at. And when it comes to the overhead, if you pay attention, we do have a small gap up to fill, right? So we do have this little tiny gap up to about $6.50, close to $7 on Boyle. Remember, these gaps, they fill about 90% of the time. Oftentimes, the 10% that never fills comes in the form of these leveraged assets and these leveraged ETFs. And so you have to be mindful of that. And remember that the big question is when these gaps are going to fill, not so much if they're going to fill. So, you know, just because we're a few dollars away from this gap up, it doesn't mean that it has to fill anytime soon. We could consolidate sideways for months, right? We could head lower for months, years even, okay? So you have to keep that in mind. Now, with that being said, we can see that this gap over here filled pretty quickly, right? The gap in between this candlestick and this candlestick, we actually got a fill on it on the next day. So, you know, I just like to chart up the gaps and know where they're at. The chart for Boyle, the chart for UNG has tons and tons of gaps to the upside. So there is a lot of upside potential. It's just very risky with the whole natural gas environment. Now, Boyle is currently making all-time lows. And I mentioned that, you know, things in UNG, you know, things that are making 52-week lows or new all-time lows, they tend to make new all-time lows and continue making new 52-week lows. Now, that cycle does not go on forever. So, you know, we started making these all-time lows over here. And, you know, there's the potential that we could see the double bottom there. But remember, if we break through 435 on Boyle, 320 is going to be the big major level. Now, let's zoom out a little bit and just go over some of the structures. All right. And really how I like to use the fibs, okay, the Fibonacci levels. Those are really, really useful for spotting trend continuation and trend reversals. So that's what we're going to do here is go ahead and highlight that for you guys real quick so that you guys can see and get a really good understanding. So the reason you use those is because nothing moves in a straight line down or in a straight line up. Rather, you get a move up, retracement, continuation of the trend, or a move down, retracement, continuation of the trend. So, you know, obviously that's how you're going to spot a trend continuation. Now, you can also use them to spot a reversal, right? Meaning if you move up, retrace, consolidate a little, and then break through those retracement levels to the downside, you can spot a downside reversal potentially. And if you move down, retrace, consolidate a little, and then break through those retracement levels, you could spot a potential upside reversal. So right here, we have an upside reversal. We have our swing high connected down to our swing low. We move down, we retrace, consolidate a little, and then look, we break through those retracement levels and put in a high and then a higher high over here. So that was a good example of a fib reversal. And right here, we have the fib rejection, which would be, in this case, trend continuation, where we have a new high. After putting in a new high from here, we have a new high now. We have a new swing low. We had this move down. We retrace up to our 50% retracement level and continue the trend down lower. So they're really useful, in my opinion, for spotting trend continuation and trend reversals. All right, the three major ones, the three most common and well-respected are going to be the 61.8, the 50%, and the 38.2% retracement levels here on the fib retracement tool, okay? So with that being said, look at this big move down that we've had ever since this retracement, right? So after we retraced to our 50% retracement level here, we really didn't get any type of retracement or move down until after we put in this low here on Boyle at 435. So with that being said, if we were to get a 38.2% retracement, that would put Boyle at about $19.10. If we retrace to the 50% mark, that would put Boyle at about $23.63. And if we retrace up to the 61.8% level, that's going to put Boyle at about 28.17. Now, there's a lot of work to be done, guys, okay? These fib tools is going off of the swing high and the swing low. If we continue to put in new lows, then we're going to have to adjust these, right? And we're going to have to adjust how these go. The only type of retracement that we got was from 435 up to the major resistance level of 795. So now let me go over some of the major resistance levels on Boyle that you guys need to be aware of. All right, 795 I just mentioned is the first one. If we are able to get past 795, okay, there is a chance we could head back up to 1461. 1461 was another major level that I had. And once we broke through there, you guys can see we pretty much just went straight down to that 795 region. So it happened pretty quickly. And, a lot of time that signifies weak structure. And so, we could see that weak structure play out back to the upside, and we could see things move back to the upside quickly if we break past 795. So that's something to be aware of. Those are some of the major levels, okay, that I'm really watching when it comes to Boyle. We do have the bullish divergence on the MACD and the RSI. But we need to pay close attention to our MACD here, because it could bounce back up and curl back up. That would be a great sign to see if you're bullish. But if this thing crosses down below, there's a really good chance that Boyle is going to break that 435 support level and head closer to that 320 level, if not lower, just depending on how the price action works. Now let's hop on over to UNG. All right, this is United States Natural Gas Fund. And so I actually started accumulating some shares of UNG after we finished our ABC structure. So if you see here, we have, an ABC right here. All right, and so your C wave is going to be the extension of your the 1.0 extension of your A to B, and that was at 752. And so I grabbed some shares right at 753 once we hit that structure, and that structure played out. And UNG's got a really good example of the fibs here as well, right? We can see very cleanly, just the fib rejections, right? And continuing the downtrend. So we have swing high, swing low. We move down, retrace up to the 61.8, and then continue that trend. We retrace up to the 50% level this time, continue that trend, all right? Retrace up to the 61.8 and continue that trend. And very similar to Boyle, we haven't really seen any type of, retracement until here recently, after we put in our bottom, which is around 715 on UNG. Okay, UNG retraced up a little bit, right, to about the $9 region, ultimately to head back down lower. So with that being said, the fib targets for UNG, if we're able to head up to there, are going to be 1271, 1443, and 1616. Those are going to be the three major retracement levels to see and establish, are we having a healthy retracement to continue this downtrend lower, or are we going to, move down, retrace, consolidate in this region, and ultimately try to break out and get some type of a reversal? Those are some of the things that I'm looking for on the macro perspective. As I mentioned earlier, we could continue heading lower after this slight retracement. We could continue trying to head lower. There are other retracement levels, right? Like if we slap one of these on, or we slap on the 23.6, okay, you can see we didn't even come up to the 23.6 retracement level. So we haven't really had like a true real retracement after this really, really big move to the downside in a lot of these natural gas ETFs, whether it's UNG or whether it's Boyle. Now, the inverse head and shoulder structure is holding up a little bit more here on UNG. Now, a lot of people think that these things have to play out so perfectly, right? That it has to be perfectly even with this level right here to be considered a left shoulder or a right shoulder. If we take a look, I think I have some head and shoulders up here that are a little bit sideways, or I had them on the Boyle charts where I was tracking them originally. But if you take a look here, guys, this is, this is still a head and shoulders, okay? And just because it's a little bit sideways doesn't mean that it's not a head and shoulders, right? We have a left shoulder here, and we have a head, and then we get a right shoulder over here. And ultimately the pattern plays out. So it doesn't have to be perfectly in a vertical, in a perfect vertical manner. It can be slightly tilted sideways, right? So if we come back over here, and we just adjust this a little bit, and we do something like this, okay? And we stretch this out a little bit more this way, and we do like this. All right, we still have a little bit of our inverse head and shoulder structure in this area when it comes to UNG. So that's something I'm still going to be looking out for. All right. Now 752, all right, is that big C wave target. That's also going to be a big support level that I'm watching. So 752 is really going to be my next major support level. Below there, we have 715. All right. Let me move this over just a little bit. 715 is my next major support level below 752 when it comes to UNG. And then below there, we have 667, 641, and 605. Those are going to be some of the big support levels that I'm going to see, you know, what happens at these levels. Do we bounce, right? Do we try to put in a double bottom at 715? That's a possible scenario. If not, and we break through 715, there's a good chance we're heading down to 667. Now, when it comes to overhead resistance, okay, 822 is my major overhead resistance, 904 and 1031. Those are going to be some of the major levels when it comes to overhead resistance before looking at any chance of getting to our major retracement levels. You know, those are the big resistance areas that I'm paying attention to. Now, if we zoom in here on our MACD as well, this one is actually starting to point down a little bit, right? So Boyle was much more flat. All right. And this one had some more, you know, gap and space in between. And if you see here, it's starting to curl down. So the big question mark is this going to turn into an exit signal? And are we going to move down below and get a bearish crossover to the downside? So, you know, you want to be prepared for all scenarios, okay, not just the bullish structures. And if you're going long on things, you want to have some type of risk management. You want to have a stop loss. Maybe you want to have a type of hedge, right? Where if you're, you know, trying to go long in Boyle, maybe you could also grab a long position in cold as a hedge, right? Maybe you could grab some put option contracts as a downside protection hedge. You just want to have some type of protection. There's a reason that they call natural gas and Boyle the widow maker, is because you can lose a lot of your money really, really quickly. And, you know, nobody's going to stay around and be married to somebody that's broke and lost all their money trading natural gas, right? So don't be a widow, okay? Don't let the widow maker, you know, take control of your life. All right, focus on some other things, focus on the basics. Remember the key levels. Remember, you can always hedge yourself for some downside protection. I have a whole video going over how to hedge with options. I would definitely watch that video on my channel. Just type in ZachlyTrades hedge with options or option hedging or something like that in the YouTube search bar, and it'll pull it up. And you know, you just want to hedge yourself with a small position, right? You don't want to put, you know, if you're putting, let's say, $1,000 in some type of long natural gas position, you don't want to also put $1,000 in the short position as well. All right, you want to have some type of you know, a ratio, okay? And so just depending on what your portfolio size is or what your position size is, and whether you're looking for either a short-term hedge or a longer-term hedge is going to affect some of the things. But I go into a nice video describing that and going over some of the different possible ways you can use options to hedge your positions. So I definitely recommend watching that. Appreciate y'all watching the video, making it this far. If you did, most likely you might enjoy one of these next two videos as well. So you can click on one of those if you don't want to watch the option hedging video.